Greece. What's your take on it?
Well, you can never say we don't live in interesting times. We've got the issues in China and issues in Europe, and Greece has been the focus over the weekend, obviously. They are in well uncharted waters. The Greek people are really suffering, and I think we've got a picture. We can
Let's have a look at the graph, because that sums it up very, very well.
So as you can see here, this graph basically charts the move in gross domestic product of the countries that you can see listed there: UK, Germany, Belgium, Finland, etc., etc. And you can see Greece at the bottom. You know, they are basically 3/4 of the economy they were in the end of the last decade. And I saw some other pictures today where their average earnings are about what they were in 1970 at the moment. So the people at the bottom of the pile are really hurting, and we saw that over the weekend.
Banks have stopped. We're supposed to live on €60 a day.
Well, if you can get €60 a day, I mean, essentially, I think this comes back to the heart of where the dispute is between Greece and the European community. Could you imagine the Reserve Bank in New Zealand ever saying to the high street banks, we're not going to support you? But that's essentially what the European Central Bank has done. And it's basically driven this, what they call their emergency liquidity agreements, where they basically are there to support the banks to make sure they've got enough euro to do what the banks need to do. And remember, the banks are paying out. They're not sort of lending the money to the people there getting the money. The people there are getting what they see as their own money that happens to be on deposit at that bank.
So I guess you're looking at people with fixed interests and fixed
incomes. You know, if you're on a pension and no savings, you can't go to the bank 3 months ago and say, oh look, I'll just take out all my savings, so when the problem really happens, I'll have it all stuffed in the mattress. If you're only being paid a pension, you can only get that pension when it's paid.
And this is people really hurting.
This is folk. I mean, when you saw that sort of 75% of the economy, what it was, and the problems have all hit across the sort of working population of Greece.
John, there's talk about no EU, or the EU disappearing, and therefore the euro disappears. They're left with the drachma, which is their pound, shillings and pence.
Potentially. Yeah. The issue is that if Greece falls out of the euro, does it fall out of the Eurozone? What is the fundamental question that's facing now everyone in the Eurozone? What's the Eurozone? Where's the Eurozone going to go? So this is not a path without pain for everybody. And my pick right now, I think they'll find a way. But we'll have to go through the brinkmanship in order to get there.
Okay, now there's a lot of debt, and this is the thing, isn't it, that Greece has got into debt with the rest of the EU. You've got another graph that you've sent us a link for.
Yeah. I mean, we can have a look at this is a graphic, and I think the link will be posted for some of these graphics.
We will indeed.
Yeah. What the graphic shows is the sort of debts coming due through time to various different debt holders, like Treasury bills, which are largely France and Germany, the European Central Bank and the IMF. And in order, it's Germany, France, Italy, Spain, the IMF and the ECB. I might be wrong about the order of the IMF and ECB in terms of who's owed the money. And that's the remember, a lot of this money is recycled money. So it's like you and I going to the bank and saying, I just want to roll over my mortgage. They're not exactly, you don't get the money to go and spend on a new car. You get the money to pay off the mortgage to get the new one.
But the thing is that the bank would say to you, yeah, but you're unable to pay the interest on that mortgage, so therefore
can we have the money, please?
Yeah.
And so now, if most of us face tomorrow to fully repay the mortgage we hold, what would we have to do?
Well, if you can't get a loan, you sell the house.
He's right. Essentially, that's it. And that's the big balloon problem that Greece has got. $300 billion of debt to pay back over 20 years. Now even the IMF are recognising that they can't do it. So now we
You can't sell a country drop.
The haircut. Well, you can, but the difficulty is who's going to buy it? How liquid's the market?
And for how much?
And for how much?
So this is a mortgagee sale of a company.
It becomes essentially a mortgagee sale of any transactionable asset.
This does affect New Zealand.
Ultimately, everything that happens in a global economy affects a player in that global economy. And New Zealand is an export-driven country. And so we've got higher exports than many other countries. And although Europe, we keep it in a sense of scale, New Zealand and Greece are very close at the high levels of where we sit in the global economy, about roughly the same size in terms of GDP. There are more people in Greece than New Zealand, but about the same GDP. It's about 2% of Europe. So that sort of gives you an idea of how big the problem is. The Europeans could fix the problem tomorrow if they really had a desire to do so. But the problem is the knock-on issue. It's around confidence and around people's willingness to buy new stuff, to buy new machines, to build new businesses, to
retire early,
to retire early, to do all those other things that without that confidence people start to do less of. And so that we've seen some reactions around the world in terms of share markets, relatively muted at this point, and certainly everything I'm seeing is that there will be a solution found. But there are people involved and people can do some strange things.
And the bottom line is, it's a bank saying, I know you can't make the interest rate, so I'm not going to lend you the money.
Or I'll lend you the money and I know you can't pay, which is basically kicking the can down the road.
Are they too far in debt? I mean, I'm saying about France and Germany. Are they owed too much to walk away?
I think they've been busy restructuring their position over the past couple of years. It'll certainly hurt less now than it would have done. But France and Germany are still the biggest debtors in terms of biggest creditors for Greece.
John, the uncertainty, is that going to hit New Zealand?
Oh, I think the uncertainty in terms of trading partner impact is clearly there. If Europe pulls ahead in a little bit as a result of uncertainty in Europe, then Europe's a reasonable market for New Zealand. 10–15% of exports from New Zealand go to Europe, so it's not insignificant. The direct banking contagion, probably not. I think we're pretty well isolated from the European and northern banks. And so directly, no. Indirectly through trading partners, indirectly through falling demand or soft markets is still an issue we need to face.
I mean, basically, we've got a situation where Russia's got an embargo on it, so therefore a lot of produce isn't going in there, but so it's staying in Europe.
Well, so
and this is just going to compound that.
Oh, if we focus just on agricultural production and dairy in particular, we've got the problems with Russia, so we're not really playing nicely with Russia at the moment, or they're not playing nicely with us, depending on which side you sort of sit on that one.
Well, neither of us.
We've just been talking about Greece and Europe, and who's playing nice depends on which side you sit on. But we've also got the quota limits being taken off in Europe, so now you can produce as much dairy as your land you can produce because the CAP isn't paying people not to produce anymore. So production's up, consumption's down or soft. That reflects in the dairy auction, that reflects in the dairy price.
And if people are being cautious because of Greece, they're going to spend less anyway.
Well, imagine, you're anywhere in New Zealand. Are you erring towards confidence or caution at the moment? Imagine sitting in Europe with the question around Greece. Are you confident or are you cautious? And caution means softer markets.
That's right, and caution means the checkbook in the bottom drawer.
That's right.
Review of the OCR.
Yeah, late this month, 26th. So this is a year since the last increase in New Zealand. Do you remember the two that we had in June and July last year? I was very strong that it was early, we shouldn't do it. Well, we've unwound one now, that was last month, and I think we'll see another late this month. And now the bank economists are talking about more cuts towards the end of the year, towards 2.5%. And we've got one bank economist saying that local and national government should start spending to put a fiscal impulse into the economy. So this is cautious talk, shall we put it that way? Cautious talk.
So what will happen? Is it something this side of Christmas?
Oh, I think we'll see a cut in July, and maybe we'll see another quarter in September and another before Christmas. And certainly if things continue to weaken, that'll happen. So what that means is lower borrowing costs. The good part about this is it takes pressure off the currency. So if you're selling exports, you know, things are not all bad right now, and that will help the dairy price, because what we see back in New Zealand dollars is based on the US dollar dairy price in the auction, and we'll see more New Zealand dollars for every dollar's worth of US.
So in reality, we should stick with the United States dollar as our main trading thing, because we don't want to know about the euro.
Well, it tends to be that, but 2-3 years ago we didn't want to know about the dollar, we wanted the euro. So this is swings and roundabouts. Hedging through multiple currencies is a good idea. Exposure to one big time and not others are not a terribly good idea at a microeconomic level.
Do you see the New Zealand dollar dropping?
Yep, I'm seeing sort of mid-60s now. I'd like to see mid-80s into Australia. That gives all our exporters a decent return for the work they do.
Providing we've got those markets.
But, well, if markets are soft, at least you see more out of the market. If the markets are soft and your currency is strong, that's the worst of both worlds.
Okay, so let's recap. How much of a shotgun has Greece's situation got to the heads of the world?
Relatively small. It's 2% of Europe, the size of New Zealand. How much of a shotgun does New Zealand hold against the world? Not a great one. But it's not wonderful at a time when there is uncertainty. Remember, the Shanghai Stock Exchange is suffering right now. The Chinese are taking real action in terms of stimulating their own economy. That's probably a bigger story, but the media at this point are reporting around Greece.
Are we looking at the stock market looking shaky because of Greece then?
Well, the stock markets around the world have come off a bit this week, but nothing hugely significant.
And would that mean that if you're still thinking that Greece is going to get out of this, aren't you?
I think what we're seeing is the typical negotiation via the media, where everybody's calling the other side awful, where everybody's saying the other side shouldn't really have a seat at the table because they're thieves and vagabonds or whatever.
Yeah,
I mean, almost those sorts of words have been used, but I think that's the negotiating positioning. I think we will see, you know, Yannis Varoufakis, saying these Greek names is quite difficult, has resigned because he was seen as a bit belligerent and a bit difficult. His replacement is seen to be more charming and lower key, but still very much in the frame of...
He's sort of a PR man, isn't he, almost?
Well, no, he comes essentially from the same educational background, Oxbridge, out of the UK, very privileged background, as Yannis did. So they sit in the same space.
So as far as we're looking at with Greece, I'm trying to sort of work out exactly what could happen because it's bankrupt.
Well, when you and I go bankrupt, what happens?
We lose everything.
We lose everything. But so does anybody we owe the money to, because once we've lost everything, they've lost whatever we owe them to. So debts are written off. So some of that debt write-off, I think, will come out of the negotiation. The IMF is saying we'll move in that direction now. Some slight movement from Europe will see Greece, I think, not necessarily back on the straight and narrow, because they do need to do a lot of stuff around their institutions. Like if you've got a tax code, make sure people pay taxes. If they don't pay taxes, then do something with enforcement, because if you don't enforce your tax code, guess what? People don't pay taxes, and if you don't pay taxes, you can't run a country. So these sorts of issues the Greeks are going to have to face up to.
And things like, I guess, no superannuation until you're 65 or 70 or whatever.
And again, rules. We have to remember that Greece comes from a history of extreme governments. It really doesn't have a long history of democratic and solid institutions. It's quite a, I don't really want to sort of create too, it's had difficulty generating a set of rules for everybody and making sure those rules stay in place. That will have to be addressed, because that's the fundamental issue around tax base and institutions. The problem with Europe is that the Greeks are seen as profligate spendthrifts who don't work very hard. but on average, they work, I think, 25% longer than the Germans. So they may not be very efficient at what they do.
Yeah,
but,
okay.
It's quite complicated. When you look at it from the distance of sitting in this part of the world, you can say, well, you know, both sides need the heads knocking together, and they need to get this sorted out. We don't need this sort of upset. It's in the margin for Europe. And so how that gets dealt with now is whether or not people come to the table with a willingness to negotiate. Because if you and I are trying to come to a solution, and we've fallen out because we can't, if one of us doesn't move our position, or hopefully both of us move our position a bit, you can't get a deal.
And finally, John, I guess if we go bankrupt and we go to the bank and the bank says, okay, we'll trade you out, the bank has a fair bit to say about how we trade out. Germany and France and Italy likely to say, well, you will do these things,
yeah. and
make it happen.
You know, we go back to my first picture. Can we get the first picture back up again? So we can see here, back in 2010, the process or the future that was first written around the first Greek bailout actually saw Greece sitting in the cluster of the other colours, but it didn't work. They continued to go south. Back in 2011, 2012, it should have been addressed and wasn't, because that downward trajectory is only going to end up in one place, the place we're in now. And so really the plan that the Troika had put in place didn't work in Greece.
They should have moved quicker than this.
They should have moved much earlier, not just kick the can down the road, and we've had those conversations before about other governments. But the reality is that when we've got 25% unemployment in Greece. Now that probably means for the disadvantaged groups, male, in their 20s with no qualifications, probably in the 80–90% unemployment sort of levels. In New Zealand, that disadvantaged group is about 25%. Our average unemployment's a bit over 5%. So the disadvantaged groups really feel it. And so that's why we can get a 61% vote. Okay, it was 61% of 60% of people who voted, so it was only 36% of the population. But nevertheless, 61% said, we'd rather have it the way it is than sign up for another deal. And the way it is isn't good.